a Ghanatube so modofo snow we masai so atena se aja konwa fefefe na ebusiafo se nya matena se de no se nsem ahodo bi enkoso ewo oman nim na entempass no ye bekwa kutie ne yahwe nsem bi a enkoso ewo oman Ghana.
And first up this afternoon, the Bank of Ghana is pressing ahead with its decision to scale back the volume of US dollars it sells in the market each month. The move forms part of the central bank's revised foreign exchange intermediation program aimed at streamlining supply and strengthening the FX market. More in the following report.
In October this year, the Bank of Ghana sold some $1.1 billion under its revised forex intermediation program. This was carried out through the domestic gold purchase program, which had used funds raised to aid payments to businesses, debt repayment, as well as that of independent power producers. Now, that amount was reduced to $1 billion in November this year. But for the month of December, the Bank of Ghana is planning to sell up to $800 million for the market. The auctions will be done twice every week through the spot avenue. The Bank of Ghana is insisting that the decision to reduce the amount was influenced by the fact that there's always less demand for dollars during this festive season. The central bank, in a circular to the traders, argued that the subsequent market interventions will be determined by current market conditions.
Joining me on Zoom, Manager Macroeconomic Research at GTB Bank PLC, Courage Boutique. Good afternoon to you. So, the Bank of Ghana's interventions have coincided with a 31-year-to-date appreciation of the cedi. From a market perspective, how significant is this performance, and what does it tell us about the effectiveness of the FX intermediation program?
Good afternoon to you and your listeners, Daryl. We've been used to depreciation year on year, and so to record 30+% appreciation is a positive. We moved from around the mid-14s to the rate we see at now. We've seen that play through inflation. We've seen that play through the cost of goods in the market and the rates at which they are increasing. We've seen that play through other macro indicators, even the debt obligations, and then the total debt stock and all that. So it's overall been a positive. And this has been possible because, one, there was a decision to begin a domestic gold purchase program that's provided an avenue for government to ramp up reserve accumulation. And to the extent you have enough reserves, we're talking 10 billion or so intervention as of November, year to November, and we're talking about 800 million for the last month of the year. So some 10.8 billion or so, which is just about, slightly short of what the reserve position is at the moment. It tells you that the gold for reserve program and the domestic gold purchase program has worked quite well as a model, which now we must safeguard and then begin to now look at market sources and other sources of FX flows that can help build up that robustness, so that we do not expose ourselves to commodity price vulnerabilities when they do happen, and how that might impact reserve. So the strategy, I believe, has worked so far. It's a positive for market. It has introduced some predictability even for the really tight season, normally where you tend to see a lot of volatility. There is now a sense of predictability. That is what businesses need to plan. That is what consumers need to plan their lives around, and their investment decisions and all that. So it's a positive. We need to build on from there and now move into the arena of diversification of our reserves and then, of course, our FX sources, so that we do not expose ourselves to some vulnerabilities when commodity price eventually kind of give up on us.
So the central bank has scaled back December dollar sales to $800 million due to what we hear as a lower FX demand during this festive season. What sort of impact do you expect this will have?
Well, I think they're doing so this based on the data available, right? We do know that normally in Q4, around December, most of the things we need to celebrate Christmas have been imported already, shipped in already. So the heavy liftings would have happened in October, November, thereabout. And then the settlement of the LCs to import these things normally start from January, February, thereabout, mostly in the first quarter. So the December period in itself doesn't hold a lot of liquid dollar demand on the market for most of these transactions because they would have been carried out already, right? So it is reasonable to think that demand has slowed a bit. Maybe things around oil import for the festive season, things around, of course, other normal demand around this period would be there, but the extra surge or spare coming from maybe festive season increment in the normal levels of demand would have been taken care of in October, November when the traders would have imported most of these things. So that additional layer of pressure would have been taken off, I believe. And that is why it is reasonable that they scale back as the data will suggest in December to take care of. So that we are not also dissipating our reserve for unsubstantiated or call it frivolous demand on the market, but we are targeting it at the needs of the market. So for me, it's expected. And my expectation is that maybe going forward, we will lighten the burden on the central bank's need to intervene on the market to now more market-based sources. And for me, that should be the next level in our FSM administration.
The Bank of Ghana has introduced a new FX operation framework aimed at reserve accumulation, reducing the volatility while remaining market neutral. How do you think this framework could impact on the city's stability and investor confidence in the months ahead?
Well, I mean, initially, that neutrality from the intervention point of view will cause some initial distortions. It's to be expected. You are coming from the point where the central bank is heavy on the market to a point where they want to move into neutrality in terms of interventions and all that, and only coming when necessary. It will cause some initial intervention. But that is exactly what I was saying when I mean we need now to move into more market-based solutions on the supply side especially. And of course, the reopening of the domestic bond market, the offshore interest in there will come to help. We've seen a robust trade accounts also, especially on the export side of things, but we also see import growing. But there is a major challenge inbuilt there. You would see around the Yuletide that things around rice, local rice, I mean, years before there was huge campaign around this period for people to patronize local rice. Today, because of CD appreciation, it looks like imported rice is way cheaper. In addition to the economies of scale and scope that these producers enjoy externally, the exchange rate appreciation also means that they are a lot cheaper. And for most consumers of local rice, cost is not an attractive thing. Same applies to poultry. Same applies to a number of other things that originally our local market was trying to close the gap on. And so those are the levers that must be looked at holistically, the appropriate interventions provided so that we can cut down the import bill. Because you could see that, yes, import has been growing, but for the year 2025, the import bill as of October seemed to be quite a surge. And that is attributable to some of these dynamics or distortions being introduced by CD appreciation, which is a good thing in the first place. We all want the CD to be strong, but we must deal with the, if you like, the excesses that come with it. And once the bond market opens, offshore investors begin to coming a lot more, confidence improve, ratings improve, FDIs begin to flow in, then the more market sources of FX can be broadened, and then the reliance on central bank can be reduced. So the initial stage was introduce some distortions, but then ultimately the market should balance it out, and we should be fine. And I think the signaling effect of a robust reserve should give the market also comfort that things are a lot better than they were some time back.
Thank you so much, Manager Macroeconomic Research, GCB Bank PLC, Courage Boti. I appreciate your time.
Yo, me na masese mo ja sopana mutie na afin so mo tan ehwe fa comment ebra comment section na menkin kan emfa mo fefefe aha eye Ghanatube so mo dofo snowy ene de insem ne ebrem on subscribe ya subscribe na afin so fa wonsa emi notification bell no se ne be ya se me de insem ne tuma na wonya ne etempa so sisi ade makram.